welcome to the special edition of the India View with me, Tanvir Gill. My guest today on the show is a global banker with a career spanning 3 decades who has in the last 5 years made India his home to push growth in HSBC's third highest profit market. Stuart Milne, who's CEO of HSBC India, joins me today in our studios to talk about India's future. Stuart, it's great to have you on the show. Thanks very much for taking out the time. Let's start off with reflecting on your last 5 years tenure in India, because you've seen a government change during that period and the transition that India has been through. What's been your experience like?
Well, Tanvir, thank you very much for having me on the show. First of all, there's been a huge change. You know, if you look at when I first came in 2012, we had interest rates at 8.5%. Interest rates are now 6.25%. We had inflation at about 11%. We have inflation now printing at record lows. So there's been a huge change in that period. And I have to say, just from the sense of feeling when I came in, it was quite a negative environment from a business standpoint. Most of our customers were really on the defensive side, whereas now things have changed and we're seeing a lot of investment coming into the country, particularly from overseas, and we're seeing that sense of dynamism re-emerge in the economy.
Suffice to say that this is the most exciting period for your tenure thus far?
Yes, it is. We've just come off a very good year. In fact, our profits in India increased 22% in 2016. So we're very happy with the progress of business, and I think we have an optimistic future.
Yeah, part of that optimism comes in from the fact that there's so much attachment about India's growth potential, right? Going up to 7.5–8%. The only worry is there's no scope for disappointment there. And so in that context, how do you look at the disappointment that's come in Q4 on the GDP number of 6.1% and what that means for the numbers for FY18, where despite GST, many analysts and economists on the street are still optimistic that we'll go past 7?
Yes. I think the first thing to remember is that the growth rates we are seeing, 6.5 or 7, whatever they are actually relatively good when you look around the world. So India, in some sense, is an island of stability in a sea of storms.
But do you think 6% is okay, is not disappointing?
No, of course it's disappointing, and the markets were disappointed. In fact, our own projections were for higher growth than that. We do think that growth will print for the full year at 7.1%, so similar to the last financial year, the same sorts of level, and then picking up to 7.5 and higher as we look forward into 19 and 20. So we do see that happening. The issue is, I guess, that growth has been slowing now since the middle of 2016, and we've seen several quarters of slowing growth. And the picture that I'm most concerned about, because it drives our business more, is that the growth we are seeing is not coming from private sector investment. It's coming from public sectors. That's the government spending money. And what we really need to see is that cycle of private sector investment starting to come back.
And we'll talk about that, but I just want to quickly quiz you on how you see the GST rollout of 1st July onwards, impacting the numbers for FY18. So far, there's not been much change. One is still going with the assumption that for this year, we will end with 7.5% growth. But can GST and the transition to GST, because it's going to be work in progress, it's not like you have a foolproof model in place, right, from the word go, can that kind of scale the numbers down?
The rollout of GST is definitely going to be positive for the economy. The question is, how positive will it be?
Yeah. And how positive in FY18?
Yes, and when you look back to when the discussions around GST first started, people were talking about 1% plus growth addition to GDP. I think now expectations have scaled back significantly, and that's a result of the narrowing ambit of GST, which is somewhat disappointing that we started off GST being X, and now we've ended up with GST being X minus. So the full potential is not going to be there, but we are going to see some positive impact. I think the other important point is that what we don't want to see is GST having a boost or delivering a boost to inflation, because that would also have an impact on future monetary policy. But actually that looks reasonably okay. So we think that there shouldn't be too much impact on inflation, but we should see the positive impact on growth coming through next year.
I mean, as a global banker, as a foreign investor, how are you looking at how prepared we are towards rolling out GST 1st July onwards? I mean, there's sound bites coming in every single day. We've had a meeting over the weekend. There's going to be one more coming up. And the finance minister is really committed in ensuring that, he gives a reasonable model on GST to start off with.
Yes, I'll go back to my earlier comment that actually we've taken something that could have been a bit more simple and we've made it very, very complicated. And therefore the rollout has been delayed already. Now, personally, I think that we are never going to be fully ready for the rollout of GST, and therefore, in a sense, you may as well pick a date. No one's going to be fully happy with that, but let's pick a date and get on with it and fix things as we go along. In the banking sector in particular, there are a lot of complications to do with the rollout of GST, and we have to work through those and make sure our systems are ready. Obviously, that's something that the Indian Banks Association has been very focused on, and making sure that the banking system is fit for purpose.
How ready is the banking system?
I think we're going to be ready on time. The issue is just going to be things are going to have to settle down over a period of time, and we'll have to see how that goes.
The other angle, and I'll talk a little bit about the growth story, going forward with in conjunction with what's expected on rates, because there's so much talk after the last policy about there being a potential for rate easing or further rate easing going forward. One rate cut or more rate cuts to come forth. Because we've already seen 175 in the system, and then there was a change in stance to neutral. How are you looking at the RBI evaluate the situation over the next 6 months? What do you expect?
I think if you look at the monetary policy statement, it's a very balanced statement, and as you say, the stance is neutral. Personally, I think that's a very sensible position to take at this point. So while the big thing we saw was the fact that inflation expectations have been scaled back significantly. So about 175 basis points less for the first half and about 100 basis points less for the second half. And that's good. But the RBI doesn't want to move too quickly on interest rates because we've got the monsoon coming up. We need to make sure that that looks good. We need to make sure that the reduction in inflation is sustainable. The last thing the markets want and the last thing the RBI wants is for interest rates to come down this month and then 6 months later they go back up again. Right? That wouldn't be helpful. So I think that provided we see a reasonable monsoon, it's quite likely we'll have a further interest rate cut in August.
Cut or cuts?
Cut. Well, at least one cut in August. But again, I think the RBI will be careful about cutting too much too quickly. So I suspect we'll see 25 basis points cut in August, and then we'll be on pause for a bit and see.
But here's the thing, Stuart. What do you think another rate cut could do in terms of spurring credit demand? What, the 175 basis points that have already been put into the system, as in addition to the liquidity-inducing measures, haven't been able to achieve?
Yes, that's a very good question. And if we look today, one of the things we see is that credit offtake in the system is very low. So on the corporate side, companies are actually paying back debt, reducing their debt. We are seeing increases on the retail side, and we can talk about that separately. But interest rates coming down on their own is not suddenly going to generate private sector investment, I don't think. The issue there is that we have overcapacity. So companies have in the past invested, they've built their capacity, they've built their factories, and for the current level of demand and the expected level of demand, they don't see a need to invest more. So that's going to continue for some time, I think. And just looking at the sort of conversations I'm having with our clients, I don't see any significant revival in private sector investment happening over the rest of 2017.
So does that mean that FY18 again turns out to be a bit of a lull when it comes to a revival in corporate earnings and a revival in business investment? Yeah,
so we are expecting, if you look at our macro view, 7.1% growth and followed by 7.5% growth for FY18. So we are expecting some pickup, and that's why I think that probably for the rest of this year we're not going to see too much pickup in terms of the private sector investment. But once we get into next year, next calendar year, I think we will start to see that investment.
So maybe the last quarter of FY18 there might be some traction. Okay, what are you observing on the retail side of your business? You wanted to talk about that as well. Is there enough data to suggest that demand is picking up for loans on the retail side? And I also believe that you're yourself looking at building your loan to deposit ratio, trying to enhance the retail side of the business.
Yeah, so from a banking system standpoint, one of the highlights right now is that we do have growth in lending on the retail side. So your average consumer is borrowing more money, both on an unsecured basis, so that's for things like credit cards and consumer spending, but also in mortgage lending. So those banks which are particularly focused on the retail segment are actually still producing quite good growth numbers. For we ourselves at HSBC, this is an area of focus, in particular unsecured lending through credit card and personal installment loans. And we think, just given the long-term demographics of India, with rising young population and urbanization, together with the fact that consumer debt levels in India are very, very low compared to most other emerging markets, there's a lot of potential long term. By long term I mean the next 10, 20 years to build a really good business in this space.
Right, but what about the commercial side of the business? Where do you see there being a lag? You've highlighted either way as a capacity problem, but business confidence is still picking up. It's just that there's a gap between business confidence versus business spending, business investment. So how can one bridge the gap, and do you think banks can play a role on that front?
Okay, so there's kind of two questions there. I mean, the first question is how do we see what's happening on the corporate side of the business as opposed to the retail? Well, clearly the market's not growing because lending is not growing. So that's bank lending, but also lending through the bond markets is not growing. For us at HSBC, we actually don't need the market as a whole to grow in order to grow our business. And that's because, number one, we're actually very small in terms of our market share in India. It is very small. So for us to grow from 1% to 2%, for us is doubling our business, but it's still a very small part of the market. So that's one thing. The other factor is that we are seeing a lot of investment coming in from overseas. So even though we're not seeing so much in terms of private sector investment at a macro level, the piece that we play to, which is that cross-border global business, is actually very active. And hence last year we saw record amounts of FDI coming into India. And that's exactly what we're here to help support, to make those connections between overseas clients and the domestic market. And
you see those numbers growing exponentially, like there being an inflection point there?
Yeah, I mean, obviously these numbers can change quite sharply from quarter to quarter depending on who's investing at that particular time. But in the longer term, we are expecting those numbers to continue to look very positive. And HSBC is one of those banks that has a very strong global network, but also has a very strong franchise here in India. So our job is to connect the two, if you like, to help Indian companies go global, and global companies execute their strategy for India.
The other angle that you have been very vocal about has been handling the bad loan situation. Being a bank, you would have a very strong view there. How are you what's the approach that you're taking to the problem, looking at it from the outside? We have almost 9.5% of loans under stress, and that number is likely to increase by March 2018. You have spoken about a bad bank being part of the solution, but we've had legacy issues on managing a bad bank, and nobody's taking the onus for that just as yet. So how do you see India having a breakthrough in this matter?
Well, first of all, the scale of the problem is very, very large, and there are different numbers put forward for the amount of stressed assets, but let's just say that the total amount of stressed assets is likely to be larger than the total amount of equity in the whole banking system. So that gives you a sense of how big a problem it is. Now, at the same time, all banks are having to increase their capital ratios under the Basel III regulation. This is the global regulation where all banks need to increase their ratios. So you've got this situation where capital ratios have to go up, but on the other hand, you've got rising bad debts, and therefore that's negative to capital. So you've got this gap in capital which is emerging. And the challenge there is that the government owns 70% of the banking system, which implies the government needs to fund 70% of that shortfall, and the government doesn't have the budget strength to be able to do that. So what could the government do? Well, they could invite the private sector to take a bigger role in the banking system. The challenge there is that requires foreign capital largely to come in and bridge that gap. And most investors are very wary of investing into domestic banks at this stage. So there are one or two exceptions, but across the board, it's unlikely we're going to see investors wanting to pick up that kind of equity. So I think the only solution, well, the solution is multifaceted, if you like. I mean, one thing is the government has to show that it's doing something about the bad debt problem. Now, the potential for a bad bank is one possible solution. It's not the only solution. But what that would do is to if you transferred the bad assets into a new institution that was professionally staffed and managed, they would then be able to work those out or run them down over a period of time and leave the banks free to focus on supporting the growth of the Indian economy. And we shouldn't forget that in India, most growth is actually funded through the banks, not through the debt capital markets. Debt capital markets are quite small. So we must have a fully functioning and healthy banking system. I guess the challenge is that if you set up a bad bank, you need to be able to transfer the bad assets from the banks today to the new institution. And because you've got public shareholders and you've got government shareholder, that has to happen at a market price. And the market price, if all the banks sold their assets at the market price, they wouldn't have very much capital left.
That's true.
So again, but nothing can happen. You can't make something out of nothing. Nothing can happen without more capital coming into the banking system.
What is the other solution? This is one solution, and it doesn't seem like we've made much headway here.
Well, the other solution is that you don't create a bad bank. You just continue to allow the existing banks to manage the assets, and you have a more benign regulatory regime where the Reserve Bank steps back and doesn't put pressure on the banks to clean up the problem. But what that is doing is effectively kicking the can down the road. And there may be a good rationale for doing that. So if you thought that banking profits were going to rise because you have a lot of demand for credit, and so the balance sheets are going to rise, going to be new loans put on, and the profits from those new loans can pay for the old bad debts, if you believe that, then that might be a viable solution. The problem is that right now we're not seeing growth happening. And therefore, the old way of approaching this kind of a problem, which is let the future growth take care of the past, the sins of the past, that's not really available. And meanwhile, by 2018, we have to meet Basel III capital requirement.
So it's a catch-22.
It is, and the only way this gets solved is by a lot more capital coming into the banking system, one way or the other.
Or selling off these loans, like I said, to a lot of these investors on haircuts. But that's
but if you sell a loan, you have to sell it at market price. No one's going to pay more than market price. If you sell it at the market price, you need to have capital to sustain that, because you'll be making losses.
Do you still think that India merits a ratings upgrade purely in terms of the progress it's made on reforms?
Yes, there has been progress made on reforms. So some landmark reforms have been passed recently, which are definitely positive, and we still have to see those reforms actually play out. So if you're a rating agency, you're not going to make any decisions around promises or words. You're going to make a decision based on data. So you need to see that flow through into the data of the country. And once it does, then hopefully we'll see some ratings moved by the big agencies. Personally, I'm not so fixated around the external rating. I think what's much more of a question is how can we generate more private sector investment, and how do we get private sector investment really moving?
What about HSBC's own plans to expand growth in India? This is the third highest profit market for HSBC. You guys have done really well this last year, but you scaled back on your branches significantly. And you're looking at the digital payments model, you're looking at UPI actively. So my question to you is, Stuart, in a market where there's so much underpenetration when it comes to the banking sector, when local banks are looking at branch expansions, we see the headlines coming in each of the quarterly earnings, looking at 100 branches by the end of FY18, 200 branches, so on and so forth. How do you work in your strategy in that environment? I know it's differentiated, but even so, how do you rationalize it?
So again, we're very focused on understanding where HSBC is relevant in a local market. So here in India, we believe that our mission, if you like, should be to facilitate cross-border trade and investment. So Indian companies going global, and global companies coming to India. That's really our number one priority. On the retail side, we focus very much on internationally aspirant customers, so customers who are or desire to have an international outlook, and we play to them. As you say, we have reduced branches last year. That impacted a very small number of our customers, actually, because these were outlying branches. And that's just reflecting trends that we see in our customer base. So our customers increasingly are not coming to branches. They're interacting with us online or on the telephone, and they just don't come to branches. I think if you look at the urban population today, more and more people have never even been to a bank branch. I know from my own children, and I know this is obviously not in India, but my own children, my eldest son is 23 years old. He's been to a bank once, and that was to open his account. He's never been to a bank again. And I think this is going to become the norm, and increasingly here in India, that's what we're seeing in terms of the behavior of customers. Customers want to have the bank on their mobile phone, and we have to change and adapt in order to make that happen.
Does that mean that you're not going to look at capturing, the rising per capita income among the middle class, the growing middle class in India, and perhaps go into tier 2, tier 3 cities? Because HSBC is always perceived to be a bank for the high profile or for the high income customers. But are you going to, in that way, my question is, wouldn't you miss out on a market which could be also part of your growth strategy, just that it's not as evolved in terms of adopting the digital payments model just as yet?
No, I think that there's huge potential on the retail side in India, and we're very much there in terms of wanting to be part of that story of that potential being realized. I think that the presence we have, which is across some of the major cities in the country, is perfectly adequate in terms of bricks and mortar to support the digital push. And if you just take a product like credit cards, nowadays most banks are acquiring half of their new credit cards online and only half of them through more traditional means. And that's going to evolve. So I think in 10 years' time, actually, no bank's going to be acquiring credit cards through men and women standing in the shopping mall and handing out application cards. It's all going to be done online.
So then how do you look at local banks that are setting up more and more branches, talking about financial inclusion and going into the deeper pockets of India?
Yeah, so then you look at the broader picture in India, and it's definitely the case that we still see numbers of bank branches rising, and I think we will see that for a few years yet. But we will then see that change, and I think knowing India and the pace of adoption of technology we see in India, which is extraordinarily high compared to other countries, what you'll see is the number of bank branches going up for some period, maybe in the next 5, 7, 10 years, and then you'll see a very sharp turnaround and bank branches will start to be closed, because you'll get to the point where financial inclusion has got to the point where it needs to be, but then the physical infrastructure can actually come down, and banks will drive growth through digital, not through physical. So if you look at any other market,
you don't see it as a missed opportunity for yourself.
No,
you think,
because I believe that digital is the future. We've had a history of innovation in digital in India going back many years ago. I mean, 30 years ago now, we were the first bank to bring ATMs to the country. We were one of the first banks to launch UPI propositions for our corporate customers. One of the first foreign bank to introduce UPI for retail customers. And we see more innovation of that nature driving our growth, and we're very optimistic actually about that growth.
So finally, from a political angle, from an economic angle, you think India is by far the most compelling story compared to the rest of the world? I'm not only talking about developed markets, but also in emerging markets. Do you think if there is one area where one would believe that there is, on a relative basis, more certainty for what may come by or come through on the political front, or in terms of economic growth, and that's India is really the bright spot?
Yeah, so I believe that is the case, and when you look at the demographic picture and you look at where India is in the stage of development, I think there's huge upside potential. The one big question in my mind is what's going to happen with jobs, and are we really going to create enough jobs in the economy to meet the aspirations of India's young people? You have 1 million new young people coming into the job market every month. Are we really providing enough jobs and enough quality of jobs to meet the aspirations of those young people. And I think
that's a global challenge as well, right?
Yes, but it is
India.
exponentially so in India, and I think that's got to be one of the biggest things on Mr. Modi's mind as he goes into the next election.
Does that mean that you're going to stay here for another 5 to 10 years to
I'll
create
stay here
more
as long
jobs?
as I am permitted to stay here, yes.
No, but create more jobs in India?
Well, you know, now HSBC has about 38,000 colleagues working in India, and not many people would be aware, but India is actually the second largest centre of employment for HSBC worldwide. And those numbers have consistently gone up over the 5 years I've been here.
Okay, well, sounds great. Thanks very much, Stuart, for joining us and giving us your views on India. Really appreciate your time.
Thank you, Tanvir.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.